Just a few weeks ago, Lam Research had lost nearly 43% of its value from its all-time high. Investors were worried that AI spending was slowing, semiconductor equipment demand was peaking, and China's restrictions would weigh on future growth. Then, almost overnight, Wall Street changed its mind. The stock surged, analysts turned more optimistic, and the entire semiconductor equipment sector moved higher. So what really changed? Was it simply an earnings beat, or did investors discover something far more important about the future of the AI supply chain? In this video, we'll separate the headlines from the evidence and uncover what Wall Street really saw beyond the earnings report. To understand why Wall Street changed its mind, we first need to understand why it turned negative in the first place. Lam Research wasn't being sold because its business had suddenly broken down. Instead, investors became increasingly concerned that AI infrastructure spending would eventually slow, China export restrictions would weigh on future growth, and demand for semiconductor manufacturing equipment had reached its peak. As those concerns spread across the market, expectations fell, and so did Lam Research's share price. By the time earnings arrived, the market was already pricing in a much weaker future. The real question is, were those fears actually supported by the evidence? At first glance, Lam Research delivered exactly what investors wanted to see. Revenue and earnings both exceeded Wall Street's expectations. But those results alone don't explain why the stock reacted so strongly. The real surprise was management's guidance. Instead of signaling caution, Lam projected revenue and earnings for the next quarter well above analysts' forecasts. That changed the conversation. Investors stopped focusing on what Lam had already achieved and started reassessing what the company could deliver in the future. In other words, Wall Street wasn't rewarding the past, it was repricing the future based on stronger-than-expected evidence. Many investors focus on whether a company beats earnings estimates. But professional investors often care much more about what comes next. Earnings tell us how the business performed over the last 3 months. Guidance tells us how management sees the next quarter and, more importantly, whether future demand is strengthening or weakening. In Lam Research's case, the guidance significantly exceeded Wall Street's expectations, suggesting that customer demand remained stronger than many investors had feared. That single message was enough to shift market expectations, making the future look more optimistic than it had just one day earlier. The most valuable information didn't come from the income statement, it came from management's commentary. During the earnings call, Lam Research described continued strength in leading-edge logic and advanced memory, both of which are being driven by AI-related investments. Management also indicated that customers are continuing to invest in increasingly complex chip manufacturing technologies, where Lam's deposition and etch tools play a critical role. This mattered because it suggested that demand was being supported by long-term technology transitions, not just short-term spending. For Wall Street, that was another piece of evidence that the semiconductor equipment cycle remained healthier than many had expected. If this had been only a Lam Research story, the market reaction would likely have been limited to a single stock. Instead, investors also turned more optimistic toward other semiconductor equipment companies. Why? Because Lam serves many of the world's leading chip manufacturers, making its results an important indicator of industry demand. Strong guidance suggested that customer spending wasn't weakening as many had feared. As a result, investors began reassessing the outlook for the broader semiconductor equipment industry. Wall Street wasn't simply rewarding one company's execution, it was responding to evidence that the industry's fundamentals could be stronger than previously expected. One of the clearest signs that Wall Street had changed its view came from analysts' reactions after the earnings release. Instead of focusing on China restrictions or the possibility of slowing wafer fabrication equipment spending, many analysts began highlighting stronger customer demand, improving visibility, and the resilience of AI-driven investments. Several also raised their price targets, reflecting higher expectations for Lam Research's future earnings rather than simply acknowledging one strong quarter. That shift in language was important because analysts weren't just updating their models, they were revising their assumptions about where the semiconductor equipment cycle could be heading next. Looking across the earnings report, management commentary, analyst reactions, and the broader sector, one message becomes clear. Wall Street wasn't simply celebrating a company that beat expectations. It was reassessing the probability that semiconductor equipment demand could remain stronger for longer. The earnings report became a catalyst because it challenged several assumptions that had been driving the stock lower for months. In investing, prices often move when expectations change, not when the numbers change. And in Lam Research's case, the market concluded that the future looked better than it had previously believed. Despite the renewed optimism, investors should remember that one strong quarter doesn't guarantee the rest of the cycle will unfold the same way. AI infrastructure spending remains heavily dependent on continued investment from hyperscale cloud providers, while geopolitical tensions and export restrictions could still affect customer demand. The semiconductor industry has also been cyclical for decades, and periods of strong growth are often followed by slower investment. That's why experienced investors don't rely on a single earnings report. Instead, they look for consistent evidence over multiple quarters before concluding that the industry's outlook has fundamentally changed. The next chapter of this story won't be written by Lam Research alone. Investors should closely watch upcoming results and commentary from companies such as TSMC, ASML, KLA, Applied Materials, and major AI infrastructure customers. If they continue to report strong capital spending plans and healthy demand for advanced manufacturing equipment, it would reinforce Wall Street's new expectations. However, if future guidance begins to weaken, today's optimism could quickly be challenged. In other words, the market has changed its mind, but now it needs continued evidence to prove that this new narrative is the right one. When Lam Research's stock fell sharply from its all-time high, the market was pricing in a future of slowing semiconductor equipment demand, weaker AI investment, and growing uncertainty. But the latest earnings report challenged those assumptions. Strong guidance, confident management commentary, improving analyst sentiment, and a positive reaction across the semiconductor equipment sector all pointed to the same conclusion: the industry's outlook may have been stronger than investors previously believed. Ultimately, Wall Street didn't change its mind because of one earnings beat. It changed its mind because the evidence supporting the bearish narrative became less convincing than the evidence supporting a more optimistic future. Lam Research's latest earnings report offered more than just strong financial results. It demonstrated how quickly markets can reprice a stock when new evidence challenges old assumptions. The biggest lesson isn't that Lam delivered an impressive quarter, it's that successful investing requires understanding how expectations evolve over time. Markets don't reward companies simply for reporting good numbers, they reward companies that change the market's view of the future. Whether this marks the beginning of a stronger semiconductor equipment cycle or simply a temporary shift in sentiment will depend on future evidence. But one thing is already clear: in investing, understanding why expectations change is often far more valuable than simply knowing what happened. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.